Hi, everybody. I'm Connie Cola, along with Jeff Hernandez of the Connie Cola Group at Launch Real Estate, and we open doors in Arizona. And we, first of all, hope that you're doing very well. It's been an incredibly stressful time for a lot of people, and we wanted to take a few minutes and answer some of your questions about what's happening in the real estate market here in the Valley. Are we moving into a recession? What does it mean for my home value? Lots of questions out there, and we're going to answer some today.
Now, certainly we've never experienced the world's economy coming to a screeching halt the way it has, and we're living in an unprecedented time. Today we want to show you 6 data points comparing today's market to 2008, which we believe will give you confidence that this crisis will be short-lived.
Yeah, lots of differences here. So first, let's talk about home appreciation. In 2008, we saw runaway prices. In fact, just last week, we were working with some clients in Fountain Hills, and we were surprised to see that there was a huge lack of inventory in a really beautiful, desirable neighborhood, really going back about 10 years. So what was happening there? Why weren't people buying and selling? Well, they were stuck there, basically. They had purchased at the height in the $800 to $1.4 million range in 2007, 2008, 2009, and then they saw the values in some cases tank by even $1 million.
Right.
So they either walked away or they stayed and they were writing it out. And that's what was happening for a lot of these people. They are still writing it out. That is a true housing crisis.
Now, today our homes are appreciating much more steadily, so we still have a solid foundation. Let's take a look at a graphic that we put together which shows the home appreciation adjustments as a result of the pandemic. Now, pre-COVID-19, appreciation was at a 4.7% rate nationally, and locally we saw a 10.7% rate of appreciation from April 2019 to April 2020, with some places in the valley even higher. Now, taking the epidemic into consideration, we're expected to slow to about a 3% rate of appreciation year over year nationally, and that's okay. It's still appreciation. In early 2021, we're projecting that we'll see appreciation of about 3.8% nationally. And once we get past this COVID-19 epidemic, 2021 is projected to end with a home appreciation value of about 4.2% nationally. Probably much better here in the Valley, but we don't know what that exact number will be just yet. Sure, that's below where we started the year, but it's not bad given what we're going through. So projecting into 2022, we're expecting to see about a 4.6% rate of appreciation nationally, assuming there are no hiccups along the way. So the bottom line on appreciation is that we will continue to rise, just not as fast as we had projected prior to the COVID-19 epidemic.
Yeah. So let's talk now about the mortgage credit availability. Big difference here too. We know in 2007, 2008, 2009 that anybody could get a loan and for just about any amount. Now, take a look at this graph that we have for you. The higher the index, the easier it is to get money. Take a look at 2004 to 2006. Easy money, and people were taking it. The lower the index, the harder it is, and that's where we are now. So it's a better bet that people who are getting loans today can actually pay their mortgage. They've been vetted better, which means that we will see less fallout as we move forward. And we've also seen banks helping us get through the next 3 months with the government programs that are out there now, with the mortgage relief programs. So we do want to caution you that if you do one of those programs, that you may have to pay that money back at the end of the 3 months. So be sure to talk to your bank about it, because everybody's doing it a little bit differently and we don't want you to get caught. But as we take a look at it now, it looks like we're really putting things in place to make sure that we move forward solidly.
Data point number 3, inventory. In 2008, we had a much different situation than we have today. Back then, we had a lot of inventory. We had a lot of new construction. The market was extremely saturated. In fact, in many places across the country back then, we saw a 10 to 11 month inventory, meaning if no new inventory came on the market, it would take 10 to 11 months to sell every single home in the inventory. That's a lot. That's a buyer's market. Typically, when inventory exceeds 6 months supply, it is a buyer's market. Phoenix's inventory was tight back then, but lending rules were loose, as Connie mentioned, so everyone lost their minds and what home values were, and people were gobbling up whatever inventory they could get their hands on at overinflated prices.
Yeah, it was kind of a free-for-all. Now, today, our biggest issue going into COVID-19 was actually a lack of inventory in the Valley. We have pent-up buyers who are coming in from out of state that want to move here. We also have people who are upsizing and downsizing. So home homes were going very quickly, but at stable prices pre-COVID-19. In fact, our business did triple the amount that we did last year, this year for January, February, and March. Sold everything that we had. So let's take a look at how COVID-19 has affected the market. As of February 9th, we had only 8,375 homes on the market in Maricopa County. Now, by April 18th, that had changed. We'd had about 11,000 homes, a little bit more than that, 11,401, and that's an increase of about 3,026 homes added to the inventory in just 7 weeks. But this is still a very low number. In fact, as you take a look at last year at this time, we had 15,217 homes on the market. So you can see we're still down about 4,000 homes than we were last year. So the bottom line on this is Maricopa County is still the fastest growing county in the country, and we can and we do need more inventory right now.
That's right. This brings us to point number 4, and that has to do with equity. When you look at the 3 years leading up to the crash of 2008, 2009, $824 billion in equity was refinanced, meaning people took out home equity loans and went on vacation, they bought luxury items, then incurred other liabilities. They bought fancy cars, jewelry, all that crazy stuff, and they bought things that really didn't make them any money. And then, poof, it all went up in smoke when the market came crashing down. Fast forward 10 years and look at the last 3 years before COVID-19, and only $232 billion in equity has been taken out. That's roughly a fourth of what was refinanced immediately prior to the Great Recession. Consumers today have much more equity in their homes, and they're keeping it there.
Yeah, they're much smarter going into this. Now, that takes us to point number 5. Since the Great Recession, a lot of homeowners have kind of gone back to school, so to speak, and they've realized that their biggest asset is probably not going to be in the stock market and in a portfolio there, but it's really in their home. So they're treating it more like a business and making sure that their largest asset is on solid ground. A lot of people, maybe you're one of them, have refinanced to get those lower interest rates. Many are even paying extra principal right now so that they shorten the amount of time that they have the loan and pay less interest. And then 53.8% of all homes, this is a beautiful statistic, have at least 50% equity. Now, that is much different than it was in 2008. 37% of all homes are free and clear of a mortgage, and on average, nationally, most homeowners have at least $177,000 in equity in their home. So, if prices drop, and most experts agree that they are not going to see a big crash here, but let's say the housing market collapses 25%, and no one's saying that that's going to happen, but let's just play a game here. That still keeps $120,000 on average of equity in everyone's home. On average. Nobody's going to walk away from $120,000. So the market, the foundation of it is very solid.
That's right. Now, let's talk about the elephant in the room, and that's unemployment. Now, people are worried this is going to be the Great Depression again, so let's address that issue for you. The Great Depression lasted 12 years from 1929 to 1942. At its peak, unemployment reached 24.9%. No, this is not the Great Depression. The Great Recession lasted 9 years from 2007 to 2016. The unemployment rate at that time peaked at 9.9%. Now, before COVID-19, unemployment rate in the United States was 3.5%. That's very strong. Are we seeing a spike in unemployment claims today? Yes. You can see from the chart that claims spiked by millions when the COVID-19 epidemic resulted in business shutdowns. But as the lights come back on and stay-at-home orders dissipate over the next few weeks, the recovery will happen much faster than either the Great Depression or the Great Recession. The economic factors that led to those two market crashes are simply not in play, and the federal government and state governments are engaged, and they're moving money much faster into the economy to blunt the effects of the COVID-19 epidemic. Now, May 8th will be another day to watch for. That's when the next unemployment report comes out from the Bureau of Labor Statistics, and we can see industry by industry where the fallout is the strongest, and we'll have a better idea what's going to happen next.
Yeah. So remember, in all of this, this is not a housing crisis, it is a health crisis. And that has caused a massive economic disruption. But once the world's wheels get spinning again and America reinvents itself just a bit, We'll be back up to full speed with new improved machines here in 4 to 12 months, not 4 to 12 years. So we hope that we've provided some comfort here and some perspective for you, some long-term thinking in all of this. Obviously, this is unprecedented, but we at the Connie Cola Group do believe that we will get through this relatively quickly, historically, because we do have a very strong foundation for our housing and our economic data going into this event. And Arizona has been leading the way in record numbers and strong numbers of growth in housing. So stay calm about it all. It is our goal always to assist you through this crisis and through life's decisions, to always be a trusted partner with all of your Arizona housing decisions. I'm Connie Cola.
And I'm Jeff Hernandez.
Call us, email us anytime with your questions. We are always here to help move you forward.